This is the floor of the New York Stock Exchange on Wall Street 20 years ago. But today, it looks more like this. Because stock trades are barely made by people anymore. They're made by these guys. Computers with artificial intelligence. Machines have taken over. Welcome to America Uncovered. I'm Chris Chappell. When you think of the stock market, you of course think of people who make money by finding honest companies with good prospects and investing in those companies over the long term. Or you think of this. The truth is, neither one is accurate anymore. The guy who told you to find honest companies with good prospects, he still probably finds a plumber by flipping through the yellow pages. Sorry, old man, the stock market is run by computers now. Also, have you heard of Google? But it's not masses of screaming people trying to sell orange juice futures either. Now, the real trading floors look more like this. Wow, feel the rush. What I'm saying is, the majority of all stock trades are now being done by computers, including computers run by artificial intelligence programs. Some of them perform only simple buy and sell transactions, which take advantage of price differences between two different stock markets. Like if you buy orange juice stocks in Chicago because they're 5 cents cheaper there, and then sell them in New York where people will pay 5 cents more. Other computer programs are incredibly complex. Some of them are even programmed to do things to manipulate prices, like flooding the exchanges with fake offers which change the bidding price and then retracting those offers. This is called spoofing, and it's all done in fractions of a second. These computer programs are making huge sums of money. Obviously, the computers themselves aren't trying to get rich. Machines don't want money. They just want the power to control the human race. And of course, they want to throw wild parties. It's we foolish humans who, in our quest to get as rich as possible, have gradually, over the past 2 decades, handed over more and more control of the stock market to computer software. Today, the floor of the New York Stock Exchange is mainly just the set backdrop for financial news shows. The actual trading is happening here. I know it looks like one of those ugly office buildings along the New Jersey Turnpike, because that's exactly where it is, Secaucus, New Jersey. The New York Stock Exchange and other exchanges have set up shop inside. Interconnected servers here are processing about 10 million messages per second to facilitate trades that are happening faster than a human can blink. This is called high-frequency trading. Trading brokerages pay huge sums of money to set up their own servers inside, because being physically closer to the exchange allows them to make stock trades faster than their competitors. Even if the difference is only a few microseconds, it's an enormous competitive advantage. That's the topic of the book Flash Boys by Michael Lewis. He talks about how one company spent $300 million to build a fiber optic cable to connect the Chicago exchange with the New York exchange based in New Jersey. To reduce the time it took to transmit data by 3 milliseconds, the company spent months drilling through the Allegheny Mountains to make the cable as straight as possible. But once they completed it, ka-ching! Brokerages forked out billions of dollars for the right to access that cable, because, like I said, those few milliseconds were a huge competitive advantage. That is, until someone else built a pair of microwave dishes in each city to transmit the same data. It was a few milliseconds faster, so that rendered their $300 million fiber optic cable instantly worthless. The point is, in the modern stock markets, speed is everything. The markets are dominated by computers, making high-frequency trades thousands of times a second. Combined, the world's stock markets are worth about $70 trillion, give or take. I mean, what's a few trillion bucks between markets, am I right? But don't worry, your money is fine. Maybe. See, in the decades before high-frequency trading became popular, the U.S. stock market had a lot of ups and downs. like the market crash in 1929 that kicked off the Great Depression, or the one in 2008 that kicked off the Great Recession, or the one in 1987, which you probably don't know about because that was the same year we got Never Gonna Give You Up, which, to be fair, has had a more lasting impact. Never gonna give you up, never gonna let you down. Anyway, those three big US stock market crashes were all caused by human error. A few people started selling, and then other people panicked, and then a huge wave of selling caused a market crash. Fortunately, now that most trades are being done by computers with artificial intelligence, it's fixed the human error problem. I mean, sure, there was that flash stock market crash back in 2010 that was probably caused by computer programming errors. But those problems have been fixed now, so these kind of flash crashes don't happen anymore. Well, okay, there have been a few more since then, but those problems have been fixed as well. Now flash crashes only happen 12 times a day, and we can't prevent them. So if high-frequency trading has so many problems, why do the stock exchanges allow it? Money. You didn't think the stock exchanges were non-profit organizations, did you? The stock exchanges, like NASDAQ and the New York Stock Exchange, they make a small percentage of every trade. So, the more trades that are made every millisecond by these computers, the more money they make. Plus, they make money by selling data streams containing critical real-time price data. Plus, they rent out server space in their facilities so brokerages can be physically closer and therefore microseconds faster than their competitors. So, whether the market goes up or down, the exchanges make money. But does high-frequency trading provide any value to the markets as a whole? Maybe. Some argue that because high-frequency trades are so prevalent, they provide liquidity to the market. That is, they help keep the money easily movable when it needs to be. In a sense, this is probably true, until it's not. Since a lot of computers are programmed the same way to interpret sell-offs, they all react in the same way. And that causes an even bigger sell-off. In other words, liquidity evaporates when it's most needed. Actually, these computer programs tend to act a lot like human traders, only faster. They have the same reactions to market changes. And some of them are programmed to do unethical things, as regulators struggle to catch up. And that shouldn't be a surprise, since it's stock traders who programmed the machines. Well, it's more like they hired the nerds they beat up in high school to program the machines. The point is, high-frequency trading is just the technological evolution of human trading. Yes, it's the beautiful future we all imagined, inside a warehouse in New Jersey. But let's say we want to reduce the negative effects of high-frequency trading. How would regulators go about doing this? There are a few options. One solution would be simply to make it illegal, but the logistics of this would be a nightmare. What constitutes high frequency? What effect could this have on more legitimate active traders? In fact, some practices, like the spoofing that some think caused the flash crashes in 2010, have already been banned. Hillary Clinton and Bernie Sanders both proposed financial transaction taxes in 2015. In Sanders' plan, trades would have been taxed at 0.5%. While this would have certainly been prohibitive for high-frequency trading, it might also hurt more traditional investors and pension plans. Another option is to tax only trades where the buying and selling of a single asset happens in less than a certain amount of time, say 1 second. This would definitely reduce the fastest high-frequency trading, but I'm sure programmers would figure out how to make trades in as close to 1 second as possible, which would negate most of the benefits of the regulation. And finally, regulators could continue to go after specific practices that are abusive, like spoofing, but not stop high-frequency trading in general. This is largely a reactionary policy, but the least invasive. At the end of the day, traders are going to do whatever they can to make money, and some of them are going to do things that are not ethical. So even though the days of Wolf of Wall Street are gone, the spirit remains. Thanks for watching this episode of America Uncovered. And remember, we rely on your Patreon support to keep the show going. Visit patreon.com/AmericaUncovered to learn more. Once again, I'm Chris Chappell. See you next time.